So we're absolutely delighted to have Tibor Kiss with us. And we're absolutely delighted to have Tibor with us. And he's both a very innovative developer of some backtesting systems that he sells, and also an extremely generous contributor to the open source community and to every trader who is looking for knowledge and insights about trading. And with that, I'll just hand it over to Tibor.
Thank you, Don, and thank you for inviting me here. It's a real pleasure to present our findings about VolZilla and one more particular event. And thank you everyone for joining this time. I know this might be early for some of you, late for others. Nonetheless, I will try to make it entertaining so that you can enjoy two recent events from the past that has some effect in the options market and the respective strategies. But before we go there, I just would like to give you a little bit of introduction and background information on myself so that you better understand how I ended up testing these strategies. My name is Tibor Kiss. I'm located in Budapest, and I'm happy to say that I'm a full-time trader since 2021. Prior to that, I was mostly in engineering type of roles, but I'm studying actively markets since 2010. Normally, my trading day or my typical day would start with coding before the bell, since I live in Euro Budapest. So I have plenty of hours to do development in the products what I use to trade. And from 3:30 Budapest time, I'm trading options in the US, equity options, index options. As I mentioned, this all started back in 2010, but I only got two options very recently at 2020. And while I was studying option strategies and option trading, I created a simulator, and I came across plenty of strategies in public space as well as in private space. And to support my learning throughout this time, I started to publish various public trades, what I recreated in MesoSim, the option simulator. This was essentially a threefold effort. One is to make sure that I have enough understanding so that I can present this to others. The second one was to showcase MesoSim capabilities, and oftentimes these strategies shaped how MesoSim behaves and how features are added to that. And last but not least, and also importantly, to ignite collaboration with others so that we can discuss these strategies and improve upon them. I think that was a successful journey. The Volatility hash theta engine as well as the Relax Super Bull are just the results of those, and I will be covering that shortly. So over these 3 years, I published 11 public strategy in the blog, and those are covering different maturities, different trading styles. Majority of them are volatility risk premium extracting strategies, but there are a few which are different interest rate trades such as box spread, or there is one directional trade, the Super Bull relaxed. Since these are, I should say these are pretty much well known, but to make this stick, I would like to walk you through on some of those which are relevant for the VolZilla event happened recently. In order to show this, I will switch to MesoLive. That's the live trading counterpart of MesoSim. This is what I use in my daily trading to enter, exit, and adjust positions. And it's a nicer interface to showcase you risk graphs. So I will be just switching back and forth and try to explain the strategies what we have at hand. The 0DT Iron Condor is something what I can't really show this to you right now because the markets are closed. I do have a trading plan for that, of course, but since markets are closed and those are 0DT, all of them are gone. Nonetheless, these 0DT Iron Condors are modeled based on Tammy Chambo's work. She made this public, I think, back in 2022 or 3. The strategy can be described by selling 5 delta puts and calls and buying protection long sides 25 points outside of this. Originally, she was publishing this to be entered on Monday, Wednesday, and Friday due to expiration availability of 0DTE options. But now this is, of course, advanced a lot. There are Tuesday and Thursday expirations. And also, meanwhile, Tammy has moved into multiple entries per day. That's something what I don't have covered in this setup. The next one, a free DTE trade, is, well, named weekend effect. In fact, this is a short strangle based on Ewan Sinclair's book. She was publishing this type of weekend premium extraction strategy in his, I think, positional option trading book. And I just made a simple trade representing this. As you can see, nothing special, just a strangle. And even though this is a weekend trade, I was able to open this today. But normally you would go on Friday, 15 minutes before close, and sell those puts and calls, and hopefully benefit by Monday on the premium decay over the weekend. The next one in the line, or the next two, is also weekend related. I call them weekend related because weekend taking a large portion out of the trade's life cycle. The boxcar trade was developed by Dan Harvey from Aeromir. I think it's a beautiful trade. It's a condo-like structure that can be put on every Thursday or Friday, and it has a certain set of rules and adjustments, but I managed to capture the initial version, the no adjust version of this. And I entered the trade today, and I also closed one for a profit, opened last week. But to showcase you the risk graph, the associated risk graph would be something like this. As you can see, since I opened, this is already up by $200 and progressing as we speak. The counterpart of this would be the Boxcar NG. That's our, or my variant of the Boxcar. I think I presented this in this meetup group back in 2022, December. I made some adjustments to the original rule set to essentially do two things. One is make this delta neutral, and you can observe the delta neutrality change the risk graph as such that the upper expiration line is below the zero. And I also made rules to stay out from the trade if the IV is elevated. So if the underlying IV rank is above 60, then we are exiting this trade. I think this modification made sense, although it wasn't in the greatest time the last 2 years for this trade, to be completely frank. The bullish market is really killing this trade because, you know, the upper expiration line is below zero, so we often end up having a small negative. Whereas if you compare this to the original boxcar trade, the upper expiration line is beyond zero, so this is slightly bullish, and it definitely works better in the recent environment. So last year, Boxcar was a much better winner than the Boxcar NG. The box spread is just an interest rate trade. We are essentially just selling and buying all the 4 contracts. The risk graph isn't too interesting, but I do have, I think, one open. Yeah, as you can see, even if you put this into other modeling software, the risk graph are just flat because we are extracting the risk-free rate from the chain. It's not too interesting. It's not really affected by the events, what we will see either. Now, the remainders, the short put ones are, I don't think they need much explanation. These are just 45 DT naked short puts from our template library. We have over 20 templates showcasing various structures and MesoSim features in the template library. The more reasonable or more interesting one would be the trailing stop version, which was essentially a trailing stop put on top of a short put. So if the idea was that we can improve this trade with it. And in some cases this works. I don't really have a dedicated job for this, but you can imagine, and I will be showing this via the Theta engine, which is also a short put trade, how the risk graph will look. Now we are reaching the directional trade of the list, Super Bull relaxed. We can thank this trade to Rafael Munoz. I hope I said your name right, Rafael. Essentially, the Super Bull relaxed trade is based on John Locke's Super Bull, but Rafael Munoz made some modifications on the trade rules to make this less restrictive and performed a little bit better. So it's actively part of our trade library now. It's essentially a call debit spread, as you can see from the screen. This is a fully directional trade. Delta is essentially, or let's put it this way, beta of the overall strategy performance is close to 1, or scaled with the respective leverage of the trade. The remainder trades are still volatility risk premium, so option selling and trying to hedge ourselves back to not to lose any money. Net zero is a very interesting one. I love to study those. Unfortunately, it's not really performing very well in the recent period, but to give you an idea how the risk graph looks, I will just go in here and show this structure to you. I think this version is developed by Andrew Faldi and extended by Mark Mosley. So I'm using Mark's variations, and I think I even myself made a little bit of change in the rules to shoot for absolute delta neutrality. So the original net zero is at, I think, 20, 40, and 60 deltas, and I modified as such that the upper long legs are chosen as such that the overall position delta is 0 at trade initiation. And now we are reaching trades which are probably the most interesting for this talk: Theta engine and volatility hedged Theta engine. Theta engine is a short put at 15 delta. The specialty of this is credit targeting. This trade originally was developed by David Sun, and the volatility hedged Theta engine is a adaptation or a change, a variant of the short put with credit targeting by Claudio Valerio, who essentially made an additional rule to add a 3 times long puts at 4 delta to end up having a put ratio back spread set up in case of elevated volatility environment. If this is too much information for you, don't worry, we will dive into details soon into this. So that's the volatility hedged Theta engine with the additional long puts, and I have a version which is just the naked short. This is the same risk graph as we would see with the short put 45 DT version, of course. If you would like to study this trade more, you should look up David Sun or the Trade Busters podcast, and you can find all his research regarding credit targeting, how to choose the number of puts to sell. Okay, so these are the contestants, what we covered over the last couple of years. So during the next few slides, we will be always looking at out of sample data when we are analyzing these events. And the first event I would like to bring your attention to was a very difficult time in option market back in 2024, August 2nd. This caused, I think, a lot of trouble for many guys. At least I was talking to some of the folks who were affected from this, and there are quite a few. So the VolZilla event, how I named this, or maybe others, is started with the yen carry trade. Basically, the participants of the yen carry trade was exiting their position due to the Bank of Japan increasing rates after Nikkei dropped 12%. This caused additional troubles in the US stock markets. But prior to this, on Friday, we saw a weak economic data in the US, and with that, the SPX gap down significantly. And by Monday, after the yen carry trade unwounded, the SPX further dropped 3% and VIX skyrocketed. This was a very unusual event. Only 3% of the drop caused a very large VIX spike, causing many headaches. The option prices went really wild. I think there were plenty of margin calls, and for some of the not so fortunate, even the accounts were completely wiped because they couldn't meet the margin requirements, and brokerages were liquidating positions at the worst possible time. During this event, or after this event, I observed one thing which might be interesting to study, even though I don't really have an exact idea how to do this, but I noticed that one of my accounts, brokers ex ante, increased the margin requirement much earlier. As you can see, what I have in this portfolio is just long calls of SPX. But as you can see, the margin requirement was certainly elevated by end of July. So I presume some had some good information on this, and just made a note myself that I should be keeping an eye on these margin requirements because they might contain some additional information. I don't really have any exact study on this, but I'm trying to keep an eye on this. And also, most recently, the margin requirements of ex ante was dropped by a huge percentage back to these normal levels after August first time. Okay, now looking at this VolZilla event with relation to the strategies I just shown you, it shouldn't be surprising that the Super Bull trade was not really affected by this one. And by the way, if you would be watching this after, or if you are opening the presentation, every link in here is just brings you to a backtest showing you what was happening during that day. And as we mentioned, or as I mentioned, the Super Bull is a directional trade. So what happened in August was not really a big deal for this particular trade. Whenever we are comparing the trade performance to SPX in this short time period, it's also useful to disable log returns so that we can see that the trade is nicely following how SPX would have behaved. It's important to note also that you can see very high CAGR max drawdown numbers. That's because I basically just took the original allocation. I didn't make any change on the backtest plan so that we can enjoy a full out of sample result in here. I think seeing these very large numbers in here will bring you to the same conclusion what I will be sharing with you at the end of the presentation. Nonetheless, Super Bull relaxed is, I think, passed with flying colors, but it's not too surprising considering it's a directional trade. What surprised me better is the volatility hedge theta engine, because that starts out as a naked short and adds a reactive hedge to the mix. This surprisingly worked really, really well, as you can see. Throughout the event, the long puts are just providing a very explosive growth in the portfolio. I probably also should turn off log returns in here just to be a comparable performance. It's a little bit tricky to assess this trade performance because by the original rules of Claudio, we will be exiting the trade after the market opened 5 minutes into the session, which is, I should say, very volatile, especially during this event. So I'm not 100% sure if you were to capture all this nice upside of the trade, but I think those put ratio back spreads are working really, really nicely, and the timing of those were nearly perfect, I should say. Now, in comparison, just to give you an idea, I will be opening the theta engine position, which doesn't have the respective long puts in the game. And you can see this is causing a huge drop in the portfolio. We are starting out with $5 million in this position or in this strategy, and dropping from 5.6 down to 4.5. So it's not at the end of the world, right? I mean, 10% drop, but still a little bit surprising considering what you see in the SPX price chart. Okay, box spread. Well, this trade doesn't really care about volatility. It's easy to see why. This is a synthetic long and a synthetic short. So everything cancels out each other, but only remains in this trade is the risk-free rate that is not really affected by volatility. The short puts are at 45 DT, basically worked similarly as theta engine, but what you can see is picked better up because we didn't have, I think, any stop loss as such, or we didn't limit ourselves by realizing losses or going after profits in this pure hypothetical example. But somehow you need to survive this, right, without being called by your broker. Now the trailing stop version is not recovering as nicely as before. That's because it tries to capture some of the profits. And of course, we are missing much of the upside related to this. In the respective blog post of VolZilla, you can see this why. There is a tiny drawing showing you how profit target and stop loss can skew your distribution of returns. I already shown theta engine. The weekend effect trade was also, I think, a little bit affected by this one. Of course, the weekend effect has kind of zero hedging power built in, just a naked position. So we see a very large drawdown going down 64%. This adjustment of the size is clearly needed for this trade. And of course, additional hedging is required to trade this. The 0DT Iron Condor is not really holding any position overnight. It's not performing super well, but during that event intraday, it also managed to pick up some losses, some noticeable losses. So what you see here, we are just going down from $25,000 to 23. Probably this is not the most useful trade to look at this right now since we have a newer version. I just need to spend some time and implement Tammy's new version and see how that would behave in this particular scenario. The next one is net zero. Well, net zero doesn't have a very successful 2024. You can see this is in a downward spiral. The August event is not really worth considering, I should say. Most interestingly, if you essentially turn this thing around and instead of buying, you are selling the same position, this will become a profitable trade. But it's certainly a puzzling one, at least for me. I have zero idea why this is working so badly most recently, even though, you know, this worked nicely in the past. Nonetheless, it's part of the library, so I included it in here. But during this August event, it was largely unaffected. And last one is the Boxcar NG. This is, again, similar problem with many weekend trades. We are losing very large drawdown or having a very large drawdown in this period. From this, I marked essentially the volatility hedge theta engine to go deeper on that. But before we jump into there, I just would like to show you a second event, which was also very painful for the weekend trades. I've been pinged by multiple guys who were suffering from this unfortunate event. This wasn't as widespread as the one in August, but it caused, I think, some reasonable headache. The broader context here is that LLMs, large language models, are just really on a rise now. Everyone is using ChatGPT, training other models, and NVDA is one of the key AI hardware suppliers with a very, very large market capitalization. And yeah, back in January, Deepseek, a Chinese startup company, just released a new model, R1, which provides competitive performance to ChatGPT and Claude with fraction of cost of training. And of course, that means all the demand for NVIDIA GPUs are probably questionable at best. If some company can train these models using the fraction of the GPUs required, NVIDIA evaluation is probably will suffer from this. This, I think, was an overreaction. NVIDIA fell 17%, and considering that large part of SPX is NVIDIA now, SPX also gapped down 2%. And that caused trouble for all the weekend trades, what we will see in the next slide. I kept the same order as before. And by the way, this order was based on Sharpie. So the highest Sharpie was at top for January till September. And in this period, I initiated the backtest 2024 October till 2025 February. The reason for the extended period here is that some of the trades are just using multiple positions in flight, so they need time to scale fully into the trade. Now you can see these colors changed a little bit. The worst one is not Boxcar NG anymore. It's the weekend effect, obviously. So maybe we can take a look in here and see how this looks. Same pattern as before. We have a lot of drawdown due to this gap, unfortunately. But the volatility hedge theta engine, once again, I should say, nicely survived. The Sharpie ratio is still above 2, and we don't really see any nasty drawdowns as with other trades. What's also interesting is Boxcar NG was the worst one, but somehow it managed to sidestep this small move. What we can learn from this that this wasn't really a volatility move. This was just a gap down, and it wasn't a very large move, so the boxcars structure was not really affected. We didn't, I think, bypass the profitable part of the risk graph. Okay, now as we observed that volatility hedge theta engine was kind of the winner for these or from these trades, I just wanted to dive a little bit deeper to explain this to you, because I think it's a very useful trade structure to study. The original theta engine is a short put with credit targeting at 90 DTE by David Sun. David has an approach that can be used to figure out the number of contracts to be sold so that you end up with a certain premium collected over the years. It's a volatility risk premium income trade. We have a variant of this called volatility hedge theta engine, which was done by Claudio Valerio, who was gracious enough to share this with us, and we featured it in our blog, and now it's part of our template library. What Claudio has been doing is extending the short put with a reactive long, well, in fact, 3 times long puts at 4 delta in cases when the IV is elevated. So we end up at, in option terms, say 3/1 put ratio back spread setup. To show this to you, how this transition works and how this trade survived this VolZilla event, I will just go to backtest. I shall mention I needed to make a little modification from Claudio's trade, but I just made it so that I can present you the risk graph. Originally, the exit schedule is set to 5 minutes after open. I needed to change that to 10 minutes so that we can capture the time when the trade is closed. But other than that, the whole trade setup is really the same to Claudio's. And if I remember correctly, I should go into position 16 in position monitor to present this to you. So position 16 is happening exactly during these troubling times. We can see that the trade starts out as a short put. And if we go a long time, when the IV rank is reaching 50, we will be adding these 3 long puts at 4 delta, and that will change the risk graph to look more like a put ratio backspread. Here we go. This happened back in July. Now, as we progress, we will be seeing how the trade is unprofitable prior to the event. But before I jump into there, I just want to zoom in a little bit and show one important matter to you. As you can see, by adding the long puts, the profit potential of this trade is largely reduced. We see that at expiration, the biggest money we can make if everything works nicely and the market is not crashing is $140. Whereas originally, just having the short puts, the profit potential of this trade was more than $3,400. So adding the long puts is really cut into our profits, but we'll see how the put ratio backspread kicks in when we move from Friday to Monday. Just trying to capture the right moment. Yeah, so this is essentially Friday, August the 2nd, 4 p.m. And you can see that the position P&L is roughly minus $2,000 for this position. And if I jump just one, you see that the P&L for this position is reaching over $9,600, $9,700 almost. So the put ratio backspread picked up on the volatility. Essentially all the T plus X lines rose, and we managed to get out 10 minutes after open. If you're trying to trade this, probably the biggest question you can ask yourself, will I be able to exit this position live? I think it's difficult to say if that's the case or not, because during pre-market you shall see some crazy wide numbers during those times, and I think those are clearly affecting your judgment. People, it's you know, in these kind of crash scenarios, I think it's very difficult to continue with your plan. You should do this, of course, that would be ideal, but mentally I think this should be challenging time to exit, especially if you see a big drawdown before and now you see a big upside. Probably you will be hanging up more. Nonetheless, following the trade rules what Claudio has put together results a similar setup. Okay, probably I will stop here and ask if anyone has questions regarding the volatility hash theta engine or the put ratio backspread, because I can dive deeper, or I can proceed with the presentation if there are no questions. Okay, let's just move on.
I guess just to ask one quick question, if I may. Isn't the usual danger or problem with put ratio backspreads that you have a valley of death and that it's pretty difficult to avoid? Does that apply here?
I think if you wait enough, you can surely end up on that valley.
So as long as you're quick off the mark, you can avoid it.
Yeah, I think the idea would be that volatility rises your current T plus X lines, you see some profits and try to exit if it hit your profit target. But it's, I think, interesting. We also have Ron Bertino in the line. I think he's also master of put ratio backspreads. He can also shed some light. But nonetheless, I think people are normally taking these trades off whenever the T plus X lines lift and you see some profits and not falling into this valley and waiting for expiration.
Okay, so you have to move really quickly to take advantage of this.
Yeah, and I think that's the difficult part. Oh, and I see also a couple of questions in the chat. What instrument is used? This is SPX index options. I'm sorry. All the backtests I'm showing here is SPX index options. And what is the trigger to add an extra hedge from Brandon? Hey, Brandon. The trigger is the underlying IV rank, and I will be zooming into this right now, how we are calculating this and what it represents. So whenever the underlying IV rank is above 50, then we are adding these trades. And readers or, you know, so you can recall that the Boxcar NG had a very similar rule set. It somehow felt like the underlying IV rank is predictive in that regard. I made an early exit in the Boxcar NG when underlying IV rank was about 60, if I remember correctly. This is probably crowd wisdom that this underlying IV rank has some relation to the outcome of the volatility risk premium trades. Nonetheless, let's just zoom into what this underlying IV rank is. Yes, I think I also mentioned that the volatility hedge is reactive. Of course, we are just adding this. But what's IV and IV rank? IV rank is just measures how the current volatility compares to its 25-week or yearly range. We can say that IV rank beyond 50, then in that case, IV is relatively high. If you would like to dive deeper how we are calculating this, I included a link. It's essentially we are calculating a summary for the underlying IV and then coming up with the underlying IV rank. But these metrics should be very close to what you see on your broker. We try to create these numbers to match interactive brokers and tastytrade's IV rank calculations. Of course, they are not fully disclosing how they are calculating the underlying IV, but at least we are doing that. So you have a sense how we are calculating it. And for those who are more visual, this would be the graph you should be looking into to compare how the underlying compares to the underlying IV rank and the underlying IV. As you can see, the red lines, the implied volatility rank is based on the implied volatility of the underlying, this purple one, and it's much more reactive to changes in IV. Essentially, whenever we see this part in here, the underlying IV rank is beyond 50, the trigger would be add those 3 times long puts to the volatility hedge strategy. And this happened quite a few times back in 2022 and also worked very nicely during COVID crash. And of course, this probably makes sense if IV is elevated and it's elevated compared to its 1-year history, then something might be up. So to me, this makes intuitive sense. But I would feel much better if we could quantify this by some means. And this is where essentially the latest development of ours comes into play, Merlin, which is doing portfolio optimization, trade optimization, as well as some statistical metrics to find predictors in strategies. We are leveraging Kramer's V. It's not to be confused with the TV show guy. This is a French mathematician, statistician who basically created a measure of association between 2 categorical variables. It's based on Pearson's chi-square test, and the strength of this is that it's said to be able to discover nonlinear relationships between predictors and targets. it has a nice functionality or nice attribute of scaling from 0 to 1. 0 meaning no association, and 1 would mean full association. And we have this available in our tool belt. So I basically take this trade and modify it as such that it would work for our experiment. I needed to make a few modifications. One is, since I wanted to study that the long part, the hedges, are essentially related to the underlying IV or not, I basically stripped this down into bare bones. I created a theta engine, a short put trade that is only was hold for 1 day instead of spending in the trade a couple of days. I modified it as such that it enters every day, exits every day. So we have enough samples to essentially see which variables are correlated to that particular day's P&L. That was the first change I made. The second one was to enter every day, of course, so that I have enough sample size. And I removed the stop loss profit target as well as this reactive adding of longs. So essentially, this is just a short put entered every day and capturing all the related variables, including underlying IV rank. And I put this into the Cramer's-V model, which will tell us if this makes statistical sense or not. Cramer's-V scales from 0 to 1, but there is no generic guideline on what should be considered weak or strong association. I asked ChatGPT and it came up with this table. What we can see here, you don't need to reach 0.5. Even from 0.3, strong association is said to be there. These are the results. What you can see, this is essentially ordered by Cramer's-V from top to bottom. For comparison, we also have the chi-squares p-value and the contingency, but Cramer's is the one what I normally look after. And the top 3 has the short put underlying IV ratio, which can be calculated by taking the short put legs IV and dividing it by the underlying IV. And the next 2 is basically the 20 or 52-week IV rank and IV percentile of that. So we do have some statistical confirmation, but I think this is pretty much well-known knowledge that IV rank, underlying IV rank, can be highly useful in hedging scenarios. Now, the remainder of the table shows, the middle part shows the moderate association. So obviously, the spot IV, underlying IV value plus the historical volatility value has some significance here. And of course, the put price, essentially just very similar metric to the put IV in this particular scenario. But there are other ones more complicated calculations, such as relative value, day of week cost. These are not too interesting in a single leg scenario, so I will just skip over. But I'm happy to report that the underlying IV rank based on Cramer's-V shows a strong association to the volatility risk premium you can find in this 90DT short put trades. So it not just makes sense, it's kind of proven at least by this metric over the last 10 years. Now, to wrap this up, I just collected some of the learnings I made during this. As I mentioned, IV rank shows some correlation with VRP performance, so probably worthwhile to study in terms of other trades as well. But the second one you might have spotted during the performance metric presentation, that sizing doesn't look right? If I go back here, you see compounded annual growth rate over 100% for the Super Bowl relaxed. And if I take a smaller time window, you can even see over 300% returns. I was personally shocked by these numbers. I thought we did our best to size these trades as much as possible and as best as possible. But it appears that this exercise should be done very frequently, because all these 100+% and 400%, it just doesn't make too much sense to me. So this kind of sizing, I think, should be frequently revisited, and everyone can judge if that's a modification to the trade plan or not. But I kept it as original, and you can see the end result. I personally have this persistent trading challenge, meaning that you can find many good trades and they work until they doesn't work, or until they don't work. And later on, maybe half a year later, you start to see some good performance once again. And it's always a question like, shall I be trading this, or why am I trading this? Probably I should be trading something different. My potential solution that again lies in this Merlin application, or latest development, which is trying to improve strategies using machine learning, ensemble learning, and methods to filter out bad entries, as well as do portfolio optimization, kind of a spaghetti on the wall approach. Whatever seems to be working, that's the one I should be trading. That's documented in our blog. Essentially, I have a portfolio construction methods. I'm using in this blog post a very good open source library called PyPortfolioOpt. And with the help of that, I managed to essentially improve a portfolio of strategy performance by a large margin using mean variance optimization. Meanwhile, this has been extended with Kelly criterion based optimization. The Kelly criterion optimization is done as such that Ernie Chan presented in his algorithmic trading book, and I think you can even find this in Delta-Ray.io as an open source application. This is from 10 years ago from me. Basically, this is just a matrix multiplication to come up with Kelly weights for the portfolio. It works really nicely for the trades I'm doing, and those are not necessarily the ones which has been showcased in this presentation. And to further explore, I think if you are interested in this, and also homework for myself is to study this entry short put underlying IV ratio as predictor hedge for triggering or filtering events. Once again, if you don't know how this is calculated, it's stated down here. Entry short put underlying IV ratio equals the short put legs IV divided by the underlying IV, and the underlying IV is described in our documentation, on the rank. What I also would be interesting to learn and see and study is delta hedging in pre-market hours, especially with relation to the weekend trades. I haven't done this yet, but theoretically, it would have been a possibility to use ES or MES futures on that particular Friday to Monday event to hedge off any deltas. It's on my to-do list to do that and see how much that would have helped in this weekend trades. And as a personal to-do, the 0DT multiple entry iron condor from Tammy, I want to study that and see if we can replace the original 0DT trade with this multiple entry. I did speak briefly with Tammy, and she says that that setup is very profitable for her. So I'm also curious if we can reproduce her results. And that's all I had for today. So thank you for your interest, and thank you for listening. And if you would happen to have any question, I'm happy to answer.
Well, I've got one question, if I may. So you mentioned that portfolio combination offers a lot of possibilities.
Yes.
What would be the components, perhaps, or hypothetical or potential components that you might be combining together in such a portfolio?
I personally have, I think, more trades than I can handle by now. Of course, you can essentially just have a more diversified approach of option selling, maybe spreading across multiple expirations, maturities, and moneyness, and just pick one that works. And since I think people are naturally gravitating toward that direction to trade what works and do not trade what's not really working, and having a quantified approach, especially via the modern portfolio theory or Kelly criterion, just I think makes sense. But you can throw in anything you really like to that one. I'm just trying to find the blog post, but the SPY portfolio optimizer works equally well if you throw in, ETFs or any stocks or even option trading strategies or more complex strategies. Then it has plenty of optimizers. I'm mostly using the mean variance optimizer. I also gave a try to the hierarchical risk parity, but that wasn't very successful for me. I hope I give a good enough answer on this.
Oh, that's great. I mean, would you also be looking to diversify across countries, the different markets, and into like interest rates and things like that?
Yeah, I think that would be really beautiful. Right now, I'm personally trying to focus on US stock market to master that first, and maybe, scale out to other markets later on. But as of now, this seems to be working fairly well, even in my limited scenario.
That's great. And you mentioned that these, well, I think you made the points. I won't repeat them, but who else has some questions or comments? Could you explain or mention that now you have some products in the market, but they're closely tied to your own research as well. And how some people have mentioned that your backtester, for instance, is different from others in the market. Is that the case?
So I think the key difference between MesoSim and others is that this is a low-code solution, whereas others either don't need any coding experience or you need to go all in and write Python code. So in that regards, I think this lies somewhere in between of the visual and coding tools. To be completely frank, I only tried OptionNet Explorer and Quant Connect during my trials. I really love Quant Connect, but it's not really made for option backtesting. And OptionNet Explorer, I think, is a great learning tool when you're starting out with options. But if you are serious to, study strategies, it is super time consuming because it takes really hours to walk through on one scenario.
Yeah, I understand. So really yours is a unique product, is that right?
I don't know. I hope it is. I wasn't able to find anything which would suit my need, so that's why I went on and created this. But it can be that my understanding is limited. At least, the open source, the free tools, the one that's available for retail, I studied, and it not really covered all these use cases. For instance, to give you one idea what's special in MesoSim is the volatility hedge theta engine adds this extra lag during the simulation. I don't think you can do this easily with various other backtesters. Let me not say any names in here. You can do this with Quant Connect, of course. You have full power. You can write Python code. You can do whatever you like. But they're just, I think, too generic backtester to work efficiently with the complexity of options.
Yeah, Quant Connect, they've added options in there, but you sort of have to code every individual leg as a security
Yes.
in their model, and you'd have to have a whole level of your, because I'm looking at that also, because there's a whole level of adaptation that you'd have to do to be able to translate. Is anybody, yeah.
Just to, I actually, the first version of my automated option trading strategy was done in Quant Connect. I observed the same problems what you outlined. You need to subscribe to the securities. It's difficult to find, therefore, legs with particular deltas or any other Greeks. I managed to overcome this, and the simulation was running for days, whereas
Yeah.
now the same simulation can finish in maybe a minute. Probably they improved ever since. I'm not really following them. But it was a little bit more difficult to tackle options using Quant Connect than with MesoSim.
Do you think that people are overly preoccupied in backtesting with nailing down particular legs and strikes, and that there should be, and maybe your product has this capability, and that a product should be able to do backtesting just on the basis of implied volatilities or something like that?
I think that's a useful idea to have. Greeks and especially deltas are easy targets, right, for people. I think they are kind of easy to understand. Whereas if you think about IVs, probably pros are doing that. I personally find it a little bit difficult to think about in terms of implied volatilities. But I know a couple of guys in FinTwit that frequently referring to these kind of structures as with relation to IVs. Nonetheless, I think studying IV is clearly important because it contains the information what you have or what the market has about that particular position. And probably that's the reason why we saw this short put by underlying IV ratio coming up and top, because this is just putting your contracts IV into relation of the wider market. And that, again, I think makes logical sense. But I personally wouldn't be able to construct a portfolio just picking IVs. It's so much easier to go with Greeks.
So do you think that the theta engine with your modifications is really a different classification of trading system, or do you think it'll hold up?
First of all, this was done by Claudio Valerio, and I think we should give credit to him, and we should thank him to, share this with us. I think it just shows two basic concepts what you can do with options, right? Like in income type of trade, selling options plus hedging, it combines the two. I would say it's a simple approach, but it works surprisingly well. And I think this is also the gist of many other income trades. You can, if you understand this, I think it will be easier to get a grasp on more complicated structures, broken wing butterflies, or even calendars. But will this held up? I think, well, option premium should be there, right? Otherwise, it wouldn't make sense to trade these. Will the put ratio back spread held up or hold up? Yeah, probably. I think it should. But time will tell.
That's great news, because I mean, isn't the conventional wisdom in portfolio management that there is no shortcut to simply paying day in, day out a premium? Isn't that what everybody else has concluded, other than, in other words, if you have a portfolio, you want to hedge it, aren't some of the other books out there saying there's nothing you can really do other than pay the premium?
Yeah. I personally would find this reactive hedging a little bit too risky for my own taste, but as you can see, it worked out nicely well. I think it's really up to the portfolio manager to decide based on risk tolerance how much protection they should be putting in place. But it's easy to see if you were to add additional hedging to the portfolio or the volatility hedge theta engine, probably the profits would be pretty much gone, because when we are converting that to a put ratio back spread, the profit potential is really minimal compared to the original one.
So it comes down to whether these tactics can really be executed. By the way, you have a new product. Is it called that does the execution? Is that right?
Oh yeah, that's the Meso Live, and this was the one I was showing the traits in. Essentially, this is just taking a MesoSim job definition, such as maybe we can take a look in the Super Bowl, and it's capable to take the backtest and trade it using interactive brokers. It helps my execution to essentially make it less painful. I don't need to use Trader Workstation or Option Explorer. I can simply say, maybe I can show this to you by some easy example. Let's go with this one. That's just a short put. So what it is doing is in the background, it's talking to my trader workstation, and you can build a position based on the trade plan you put together in MesoSim, and you can see this formula I'm highlighting. That's the credit targeting part of the theta engine. You can see we are targeting some, I think, 13%. And once it found the leg, the strike for this 15 delta target, it will be showing a risk graph. Unfortunately, after hours, the trader workstation is not the fastest, so it might take some time until we find this lonely 15 delta leg. Nonetheless, all the positions what I have shown in here created or liquidated was creating using this tool.
So when you see a circle, that circle arrow, what it's doing, it's going through the option chains looking for legs that meet your criteria?
That is correct. So we were looking for 15 delta puts in that particular case, I think 19 days out. It was a pity that it wasn't showing up so quickly. Nonetheless, that's pretty much it. It's not a very complicated user interface. It just helps you to enter, adjust, and exit trades. So you can add this additional leg if needed to have the longs in there. And the great part is that what strategy you develop in MesoSim can be drag and dropped over here, so you don't need to think about the execution plan and the trade plan.
So is that like, are people using that?
Yeah. We have a handful of users already enjoying this product, including myself.
Great. Who else has some questions or comments? Ron, do you have some comments? Or who, hang on, we got somebody here. Let me just see. Alan, go ahead. Or Misha. I don't know, maybe those people just turned on their mics accidentally.
No problem.
Yeah, go ahead.
No, I think this was what I meant to cover. So
Yeah.
if you guys are curious about this, feel free to, try MesoSim out. We provide a beta program so you can take these strategies and play around with it. And from my side, as I mentioned, I do have a couple of to-do items to keep this thing going and keep the research going. So I will be studying the multi-entry Iron Condor, and maybe we will see some good results with that one.
Oh, you said you have a, go ahead.
Sorry. I was just going to say, when you're ready, I can jump in with a little quick tip, but you guys.
Please do, Ron.
Okay. Yeah. Actually, Tibor, if you don't mind, would you mind going back to that slide where you had the $9,000 of the putback ratio being shown? I just wanted to share a little tip for people that don't, or that aren't familiar with these types of structures. So when you're in a situation where you've got something like this putback ratio style trade and the markets have crashed, then with the IV spike, these things should hopefully be making money because they can be put on as a Vega hedge. And actually, would you mind going to the slide that actually showed the profit, Tibor? I think it was like 9 grand or something.
Yeah, that was not. I think that was in.
Oh, really? You were demoing it live?
But
That'll do. That's
I
perfect.
have this screenshot in here, so probably you can see this.
Yeah,
that's
perfect.
Yeah.
All right, so something like that. And the comment came up about saying, since the market is crashing, it may be extremely difficult to get executed on exiting this trade. Now, that comment is fair, I would say, if you're looking to exit the entire position. So what tends to happen during market crashes is that, of course, liquidity is going to dry up. People are extremely hesitant to put things on, and that includes the people on the other side of your trade, including the market makers. So bid-ask spreads go insanely wide. Like during the August crash, we saw bid-ask spreads go to like $100 to $200 wide sometimes, which was, insane. So it can definitely be tricky to exit when you've got crazy bid-ask spreads, and that gets made even worse when you're talking about complex positions, because now you've got the bid-ask spreads per leg, and if you've got a complex position that has, like in this case, it's basically 1 short put and 3 long puts further down, so it's 2 legs, but it's essentially you're trying to get out of 4 contracts, but it's a blend of shorts and longs. That can be tricky. If you then have even more complex structures, broken wing flies and blah, 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 that can be tricky to exit the entire thing. Okay. But one of the little things that you can experiment with, and I know it's difficult to live trade this by backtesting it, because this only happens typically during market crashes, but you can definitely backtest the concept easily in OptionNet Explorer, such that you can then replicate it during a market crash to a decent degree anyway. And what I'm referring through to there is peeling out instead of trying to get out of your entire position. So for example, here, this back ratio on the right-hand side is showing a profit of say $9,000. And your eyeballs will your greed will kick in and you go, fine, I want to try and get out for 9K and be happy. And you won't be able to, because it's a complex position and the market's crazy. But think about what people in a market crash want, right? They want long puts. They want to protect their portfolios, their stock portfolios, ETFs, and all that kind of stuff. That is what they want to buy. They want to buy that protection, that insurance. So the market is extremely hungry for buying puts, okay? But nobody's going to want to be selling puts unless you're crazy, unless your risk tolerance is insane. So my point here is that, remember what this structure is that it's 1 short put at the right and then 3 long puts at the bottom. So what you could consider, of course, you could try to exit the entire position, but in all likelihood, you won't be able to. So in that scenario, what you could consider is maybe saying, what if I simply sold 1 of my 3 long puts from the bottom on the left? Okay, and think about what that is, because what you've got a long already in your portfolio, and you're now saying you want to exit that 1 long put, which means you're selling that long put to somebody else that is super hungry for it. So the ability for you to do that is actually on a relative basis, of course, the simplest thing that you can do during a market crash, because everybody wants to buy long puts for protecting their own portfolio. So if you're a person on the other side of that trade offering them a long put, the likelihood of you getting filled on that is, on a relative basis, very high compared to every other option that's out there. Okay, so now that is not going to allow you to fully book your $9,000, but it will allow you to lock in some of those profits. Okay, so maybe you might be able to book, I don't know, 2 grand out of that 9 grand. Now your risk graph is going to change, of course, when that happens. And the risk graph isn't going to look as pretty to the downside in terms of having that hockey stick to the downside if the market keeps crashing. It's going to flatten out. And the reality is that if the market keeps crashing, you probably won't make much more money. But it's a way that you can basically cash out on partial profits if you choose to do so, right? Now, if this structure here is protecting other income structures that still have huge Vega risk, you obviously don't want to do that. But if your trade plan, which is basically the kind of stuff that, or the types of methods that we go through in our community, if our trade plan for our income structure get hit, of which there's various rules for that, but we will actually peel out of our income trade, which means that we're so-called booking that loss, but we leave our black swan hedging, which will look something like this, on. But we then also have very specific criteria of how to then either peel out or close off that particular position based on various other factors. So, again, my point is that if you've already peeled out, if you don't have the income structures that need further protection from these hedges, that is an opportunity for you to, so you're in a scenario that the only thing that's in your book is basically this kind of black swan hedge, putback ratio, and you say, I want to be able to book at least some of these profits based on this IV explosion. I don't want to risk the market now bouncing and IV crashes and all those profits go away. So you could consider, in this scenario, selling one of your 3 long puts in order to book some of the money that's available to you during the crash.
Absolutely. People shouldn't be hung up on the particular legs they happen to have. They should look at the overall Greeks of the market and give some of the and offset some of those.
Yeah, but I guess the key is that during a market crash, forget about being able to exit a complex position with multiple legs, but the ability for you to sell one of your existing long puts to someone else that is absolutely dead hungry for it is quite viable.
That's going to be the easiest of all because it's just one leg.
It's not just one leg. It's the leg that they want to buy.
Exactly right.
Like drastically, they're super hungry for it. They want to buy a long put because they want to protect their ETFs and their stock portfolios. So there's plenty of people lined up willing to buy it. And so for you to be on the other side of that trade makes the trade on a relative basis very simple to actually get filled.
You might even make a killing by overcharging by far the market.
Yeah, absolutely. Yeah.
In fact, I had a similar structure up in that Monday, and I managed to exit the whole put ratio backstride at once. Probably I was lucky,
nice.
but it worked out nicely. Of course, I think timing is really key here. So, as also Brandon wrote, profits can easily evaporate very quickly. Volatility fades, but yeah. It's difficult. I think also the mental aspect of this when you are seeing this live is so much different than just looking at this graph. Yeah.
I hear people saying also that futures options are easier to exit. That they'll always make a market no matter how complex the structure you have.
No, I wouldn't agree with
that. Yeah, well, there's no truth. There's just
SPX, I mean, just look at the actual trade volume on a daily basis, right? SPX options have vastly more options traded than ES options.
Well,
so, yeah,
that's certainly true. And one would have to suppose that they have better models of the market makers in futures for it to be true.
No, I don't think the models have anything to do with it. I think it's just a matter of how much of this thing actually is traded on a daily basis. And during a market crash, then you'll have the same kind of stuff. It's just everything is amplified. If bid-ask spreads on SPX are crazy, you can expect the bid-ask spreads to be just as crazy for ES options as well. Probably worse.
They're being arbitraged against each other all the time as well. Well, that's fantastic. I mean, I think there's really a whole course there in what Tibor has presented. I'd encourage people to go back over it. We really appreciate the numerous insights that have been offered. And I guess we better let Tibor go because it's already ridiculously late in Budapest.
Yeah. Thank you so much for this opportunity, Don. It was a pleasure presenting, and I hope this was entertaining enough and providing some additional details on top of the original blog post. So thanks everyone for joining. I will sign off from here. Good night.
Okay, thank you. Good night. And now, did anyone, Tibor, thank you. We'll let you go. Please go to get some sleep. Does anyone else have any other comments they want to add, or should we just leave it there? I would like to, yeah, there will be a PDF, Becky. There is a PDF. Well, we'll let Tibor, make any final revisions he wants. So I think he's still making changes, and he'll send that to me. And if you can't, check on our website. Well, actually, look on our YouTube site, and we'll have a link to it there, which is RDU Traders on YouTube. @RDU Traders. And we'll have the video, and we'll also have the recording, and we'll also have a link to the PDF very soon, within a couple of days, within a few days. Thank you also to Ron and everyone else for their insights. I think we'll leave it at that. Thank you to everybody, and good night.